This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you can find the download link for your post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Marco's picture saying looking for the downloads. Now, Eric, let's start with crude oil and the EIA inventory.
EIA printed another gigantic drawdown this week. It was 3.9 million barrels, not quite as big as last week's drawdown. Cushing, Oklahoma drawing down another 1.6 million barrels this week. But the big news is on finished products. Now, remember last week there were those big builds on finished products that offset the crude oil drawdown, resulting in a net petroleum build. What I said last week is keep a close eye on this, folks, because that turnaround in the crude may lead to a turnaround in the products. Sure enough, that's what we've got this week with a gigantic 5.6 million barrel drawdown on gasoline, another 2.8 million barrels of distillates. Add that with the crude, and you end up with a net petroleum drawdown of 12.3 million barrels. U.S. production still holding steady at 13.3 million barrels. That is the plateau level. I believe it's an all-time high. There might have been one print at 13.4, but I don't think so. The market had already sold off well below its 200-day moving average before inventory came out. The big drawdown arrested that falling knife of selling, but the bounce back above the 200-day moving average was kind of muted and not all that convincing. We got up to $78 and back down to $77.50 as I'm recording. So, let's see how it goes from here. Overall, though, the outlook is improving with this week's inventory trend confirming last week's initial trend change indication and products following suit with crude on the drawdowns. But just as one data print doesn't make a new trend, just two data prints doesn't confirm a new trend. So in my mind, the jury's still out on whether the broad stock market weakness that's dragging the S&P 500 and copper, for that matter, much lower on Wednesday, is that just the beginning of something that's going to get worse, or are we going to drag crude oil all the way down to new lows as we get into a panic sell-off in equities due to uncertainty fears going into the election? Or am I the only paranoid one who's worried about that? Well, I guess we'll find out. The market will tell us, won't it?
Yeah, Eric, I was approaching this pullback as a potential buy on dip opportunity. But what really is now happening in the bigger landscape is we're seeing very direct and broad distribution in the entire commodity space and risk off in both commodities and equities. And so oil didn't hold my key buy zone area and continues to deteriorate. That doesn't make me overly bearish. I think that oil is very clearly established some key support lines, and at this stage, maybe that next support line is going to be the June low. But overall, that buy zone I was looking for didn't work out, and so let's see where crude oil settles in here. Okay, guys, so let's move on to equities. So, Eric, I know you had some thoughts here on the S&P. What are you thinking?
I think equity markets are repricing the election risks, and I don't think that process of repricing those risks has yet completed. After President Biden was forced out of the presidential race, the market at first began to reprice a near certain Trump win and a full Republican sweep after Tucker Carlson went to the RNC and said, "Trump's already won." Look, markets hate uncertainty. And at first, market participants thought that news flow meant that the presidential election outcome was almost already decided in Trump's favor. But I believe that cooler minds are now finally starting to take over and think this through. And as I emphasized in the feature interview with Marco, this situation is anything but certain. Former President Trump has more enemies who are committed to keeping him out of the White House at any cost than probably any other presidential candidate in our lifetime, certainly, and maybe in the nation's history. It now seems clear that their favored tactic of lawfare is not going to keep Trump out of the White House. And as awkward as it might be to talk about such horrible things on a podcast, that's our job here. We need to look at the risks. And this election is a whole lot less certain than it was 3 weeks ago. Not more certain. We know for a fact now that the U.S. Secret Service is challenged in its ability to protect Mr. Trump from a 20-year-old kid who we're told, we should believe, was acting alone without any significant assistance. And it would be irrational to assume that there will be no further attempts on President Trump's life after the whole world has just learned that it might be easier than everybody assumed. As the market slowly digests this information, which most people don't even feel comfortable thinking about because it involves life and death and horrible crimes, well, once people calm down and recognize that we do have to think this through, I think we're going to recognize that there's a risk of a very significant risk-off event between now and the election. And I'm not being partisan saying I want my guy to win instead of the other guy. It's not about parties or who wins the election. The point is a sane analysis tells you that Biden is already out of this race. Harris is a very weak candidate, and we don't know for certain what's going to happen next with President Trump, but we do know for certain that the security services who are assigned to protecting him have not performed particularly well thus far. As the emotion and hysteria drains out of the system, I think these cooler heads are going to realize that left tail risks just got a whole lot bigger. And it's a far left outlier risk, to be sure. It's definitely not the base case. I'm not making any dire predictions here. But as horrible as it feels to even talk about such things, another act of violence upsetting this historic presidential race is not something that we should consider to be out of the realm of possibility. In fact, I'll go on record as saying that I think the odds are far higher than 50% that at least one more attempt will be made by someone somewhere on President Trump's life before the election or inauguration. Now, I certainly hope that that does not happen, and I certainly hope that if there is an attempt, that the government gets their act together and provides adequate protection so that it can't possibly succeed. But to think that the election outcome is right now in this moment much more certain than it was a few weeks ago is foolish, and I think that's starting to be discounted by the market. Whether this turns into a really big risk-off event or just a little hiccup is going to depend on whether I'm the only person crazy enough to see it this way. So let's see what happens. I definitely have an extremely non-consensus view right now, but honestly, I think the only reason for that is because the consensus is freaked out by the news flow and not wanting to face the risks that are staring us in the face.
All right, I want to get Nick involved in the conversation. Nick, let's just start off by talking about the levels on the S&P 500.
Yeah, Patrick. So right now, SPX is at approximately 54.30. And we have an implied move for the August 16th monthly OPEX of plus minus 170 points, which is actually up from last week as implied volatility is expanding right now. Right now, the upper implied move for that monthly OPEX is 5,600, and that lower implied move is 5,360, just below the key support level of 5,400. Right now, key resistance is at all-time highs at 5,670, and I'm inclined to think we see a further decline lower toward that 5,350 area perhaps, before seeing a bounce higher.
Nick, to me, this is an incredibly important inflection point. From a short-term swing trading basis, we have reached an oversold state on the hourly charts that basically would often be the turn point for where we get a market bounce. This corresponds with a 50% retracement of the June to July rally, and as well where the 50-day moving average lies. And so this is a very logical place for the market to offer a reaction higher, particularly if the market goes into a holding pattern into next week's earnings, where we have that next wave of Mag 7 earnings coming out, and maybe that will be the next major trend driver starting on Wednesday of next week. The part that, though, is what makes this an inflection point is that we've really reached quite a sensitive moment. When you look at systematic trading, when you look at broad equity positioning, the weighting in CTA portfolios, vol targeting funds, how they were positioned, all the short gamma that dealers may be holding, this is a moment where the market needs to hold, because if the level gives out here and we start seeing a breakdown from here, the systematic selling might just take over, and we might have a bottleneck liquidity event as people are just being forced, whether margin calls, compliance departments, or whatever else is coming in, and suddenly we have a little bit of a spill in the market. Now, I agree with you on the level. Like if the 50-day moving average here doesn't hold and offer the support line, the most logical place for the S&P to target next is what were the March and May highs around that 5,300 level. But really, once we're under this 5,400 area, the animal spirit and investor psyche could really take over, and we could have a little bit of a bigger spill. Overall, I'm not thinking that this is where a big crash happens, but I don't think investors are positioned for more market volatility. And if it was to arise, that's where we could see big spikes in the VIX and some real fear kick into this market. What I wanted, though, Nick, talk about is the Russell, because on page 4, the Russell seems to have been a little bit of a safe haven. Are you still bullish here?
Yeah, Patrick, I'm still bullish here. I think that we can see some outperformance in the small caps as they've underperformed for the past year or so. And I've been saying the past few months that I thought big tech would roll over and that money would roll into the small caps. And right now, I think we see some upside in the Russell toward that 2,400 area, all-time highs on Russell as the big tech names roll over and that money goes into the small caps.
Nick, I get the idea of the Russell outperforming. And if you're looking at it as a factor where you're taking the Russell long against a QQQ short, then the outperformance of the Russell against the Qs is likely to prevail. The bigger question is can we see almost like a negative correlation where the rest of the markets are selling and the Russell is rallying in that environment? And my confidence level of that is not so high. While I do think that there'll be relative outperformance of the Russell, I think that if the market here downturns, that almost any equity market is not going to be a place to hide. And I would be expecting the Russell to give it back. But like we were talking about earlier on equities, this is an important inflection point, and the market should bounce here. This is a 50-day moving average. This is where it's on the short term oversold. And sure, if the market here bounces off the support level on the S&P and rallies higher, then yeah, maybe the Russell outperforms in the upside on that. But if we get a liquidity event of any form, Russell, I don't think is going to be a place to hide. And nonetheless, let's move on to page 5, where we have the Nasdaq QQQ chart up here. What levels are you watching here, bud?
So right now, spot price on Qs is approximately 462, and we have an implied move for the August 16th monthly OPEX of plus minus 20 points, which is up from last week as implied volatility has expanded on the decline. The implied move to the upside is therefore 482, and to the downside, it is 442. And right now we have key resistance at all-time highs at the 504 area and key support just below the current price at 460 or so. So right now I'm looking for is perhaps a decline a bit further toward the 450 area on Qs, but I do see a small bounce happening in the next few weeks as earnings come in. Google's earnings were poor. So were Tesla's, but if NVIDIA blows it out of the water again, as well as, say, for example, Apple and Amazon, we might see some upside.
I mean, that really is the case, isn't it? And that's why I was thinking the market here could bounce, because I think at this stage, it makes a lot of sense for the market to wait to see what happens on those big earnings. Overall, I think that market participants are trying to read whether or not the bigger AI CapEx spending cycle has played itself out. We're already in the 5th quarter of the CapEx expansion. Sometimes after 4 to 6 quarters is where these things pause. And I think the earnings are going to play an important tell as to whether or not we're turning that point. And so the Nasdaq here settling in somewhere on the short term and waiting for those earnings announcements makes a lot of sense. Nonetheless, let's move on to page 6, where we have the volatility index, and finally some volatility-driven fear being back in the marketplace. We're back to those April highs during the last market correction, and again, a very interesting moment because just like the April high, that marked that short-term low of the correction. And we find ourselves at a 50-day moving average with this type of a spike. Is this going to be kind of that short-term peak in the VIX, or does this spill into one of those bigger moves that ends up getting up to the 25-30 level on the VIX, is where real carnage starts to be priced into the market? What are levels are you watching here on the VIX?
So right now with the VIX at about a 19 handle, we can expect to see intraday top to bottom moves of about 1.25% on the S&P. And I've been saying for the past few months that if you're holding a long portfolio that correlates heavily to the S&P 500, it would be very, very wise to buy some insurance when it's very cheap, especially as we roll into that election cycle toward the end of this year. And right now we have a few anomalous events that have happened over the last couple of weeks with the Trump assassination attempt, as well as Biden dropping out of the race. Now we have Kamala Harris as the Democratic nominee. And this has kind of thrown a bit of uncertainty into the market, which the market does not like at all. So hedging right now would be prudent, but hedging, last week or the week before would have been more prudent when insurance was much cheaper. That being said, if you're still heavily correlated with the S&P 500 in your portfolio, it makes sense to look at some hedges because, again, with uncertainty, we may see some further downside overall. Now, Patrick, previously you had that webinar about hedging about a month ago or so. I'm curious as to your thoughts right now as to how you'd hedge.
Yeah, it's interesting. A lot of the hedges are coming through, like the straddle's already up 100%. But the thing is that with the VIX already up here, it's certainly not cheap to begin brand new hedging. This is where we change our strategies and have to use some sort of theta offsets. And this is where you get into taking advantage of the steeper skews in the options market and implement things through things like debit spreads. It's something I talk about with my members all the time. There is still opportunity, but it's no longer just going long gamma with puts that's going to work. Volatility premium is starting to spike, making these premiums a little more rich. Now, moving on to the dollar index, I just wanted to quickly highlight the dollar itself is not doing much, a little bit of a pullback in the euro, but the big move has to be what's happening in the US dollar yen. And that yen has been ripping as the US dollar against the yen has been going through a material decline. We're now actually approaching a very key support line in the 150 to 152 on the US dollar yen. And I actually think that this is where there's a very good likelihood that the short-term support will offer at least a reactionary bounce, maybe not a change in trend or a new US dollar rally, but certainly I think the very short-term kind of bloodbath that's been happening in this Forex cross really is likely to have run its short-term course.
Now moving on to page 8, we have that gold futures chart. What are you guys thinking here?
Well, what we've seen so far was the market sold off to approximately its 50% retracement level of this recent rally. That was just around 2390 or so. I think the actual low was 2387 or 6 or something like that. That was the 50%. We got a nice, big, beautiful bounce off of that, which maybe gave the bulls a little bit of reassurance. Was it $35-40 all the way up just to the 8-day moving average, where the rally stalled and reversed on Wednesday. Now, I do think that this is all happening because gold is selling off in sympathy with the stock market and everything else, copper, everything else that's selling off today. But look, folks, history teaches us that when the fundamentals say gold should go up and other stuff like stocks and commodities should go down, what almost always happens is gold gets dragged down with everything else, because when you have to sell, you sell what you can. Because when you're forced to sell, you sell what you can, not what you want to. And that's what's always happened before. 2008 was a prime example of that. So if there's a big risk-off event in the stock market, I expect it to take the gold market with it, at least temporarily. Now, eventually, I think all the reasons that there are big risks in the stock market are also very, very bullish for for gold in the longer term. But fundamentals come second only to liquidity. And any reasonable analysis of how much levered length exists in this gold market clearly concludes that a big risk-off event across all markets is going to take gold down, even if the fundamentals suggest it ought to be going the other direction. So bottom line, I remain super duper bullish gold long term, but I'm not persuaded that the swing low is in yet for this correction. And I think that if the risk off event in the equity market gets a lot worse from here, it's going to take gold with it, at least initially. And that's not for a day or two. That's for weeks to months before eventually the fundamentals force gold up as other things sell off.
Well, listen, we had a bullish breakout to an all-time new high, but what was really interesting about it is it wasn't confirmed by the other precious metals. Silver didn't move. You didn't see platinum and palladium moving with that. Little bit of a bump in some of the gold equities, but really not the follow-through that one would have really wanted to see. Now, what is happening this morning at the time of recording is we have a $50 down day, breaking fib zones, but at least still supported by its 50-day moving average. I think the biggest blow to the bulls would be is if we sold all the way back down to the June low, because that would nullify this as a breakout and then put gold back into the trade range and even leave it on the table that it may still correct more. Overall, I'm super bullish gold, but what we were trying to decipher is whether this breakout to an all-time new high was the beginning of another new bull trend on the upside. This 50-day moving average, in my mind, is going to be a critical line of support, and we'll see whether it holds.
And moving on to page 9, we have that uranium chart. Eric, what are your thoughts here?
My view of the uranium mining shares market usually mirrors that of our good friend Justin Hune over at uraniuminsider.com almost exactly. But our views are starting to diverge with respect to the timing of the coming bottom in uranium shares, which Justin and I both agree is coming sooner or later. We're in agreement that the nuclear renaissance is on and it's on strong, and that the outlook for uranium is super bullish long term. But for now, we're stuck in the summer doldrums where there's almost no trading action on the physical spot market. Justin thinks that we're really getting close to the end of this correction, which has lasted all year. He's cautiously anticipating a possible bottom this week or next week, and he's saying, hey folks, look at the seasonality of what happened last year. Maybe we're going to see a similar pattern. Now, I think he's got exactly the right idea of what's going to happen. I just disagree slightly on the timing. Where we differ is the charts are already looking awful from a technical perspective, and given my view that broader markets, frankly, should be looking at a bigger risk-off event, because I think that the election risks are bigger than most people do, well, then it would logically make sense that we would see that risk-off event continue. And just as I explained that gold would be dragged lower by the stock market, uranium shares, which have extremely high retail participation, are more likely to be the location of a panic event among retail traders. They're going to sell off harder than the broader stock market. So Justin and I are exactly on the same page that uranium has already sold off more than the fundamentals suggest that it should, that it's bargain priced right now, and hopefully that there will be a recovery soon. The place where we differ is I see a very significant risk that this uranium situation just gets worse for weeks to months before it gets better. And it will get better, but it doesn't need to get better until the physical market really forces the rest of the hand. Now, already SPUT, that's the Sprott Physical Uranium Trust, is trading at such a discount to its own net asset value that the implied price of uranium, if you buy the SPUT shares, even though the current market price of uranium is around $83 or so, you're buying for about $74, $75. Hey, wait a minute. That's less than the long-term term contracting price in the main market. So obviously we're at bargain levels here. And I think Justin is making an excellent call that this is a bargain level place where, this might be the bottom really close. I'm just really nervous about this election thing. And I'll be the first to admit that I have stronger views than most people. So if you think I'm a nutcase on the election, I would follow Justin's advice that right here, right now is the opportunity to buy. Bottom line, I'm not selling anything here. I'm already very much overweight uranium mining shares, and I'm extremely confident that I will eventually sell them much higher than I bought them. But I'm kind of bracing for something to come next that might be painful. Let's see what happens.
Eric, just technically looking at this uranium physical trust, it's being distributed. Everyone keeps hitting the bid. All rallies are failing at the moving averages. There's some sort of distribution cycle getting underway. Now, overall, the bull thesis on uranium is very strong. And at some point, there will be the next start of the bull phase. But the way that this price action is behaving on the short term, it means that the distribution cycle has not fully played out yet. And we still have to see where the lows will come in, where the buying and accumulation cycle starts. I think investors in the uranium space have to be a little bit more patient here as this develops. The last thing I wanted to touch on page 10 is that U.S. 10-year Treasury yield. And we have it once again turning back down. It's trading around 4.22 right now. And what we really see is the fact that bonds are, to some degree or another, behaving as a bit of a safe haven. And this is something that has been a part of my bigger thesis. I'm not super bullish bonds, where I think bonds are going to rip with a huge return on the upside. But I also don't think that they're going to be selling on the downside with the rest of the markets the way they did through 2022 and 23. And so to me, this is a place to hide, pick up yield, and find some safe haven during these difficult market periods.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.